Can a seasoned short seller's trading intuition be perfectly replicated? Today, we are decoding the RAHA short strategy that transforms years of battle-tested wisdom into executable code. Hello everyone, welcome to the Inventor Strategy Analysis channel, where we dig deep into strategy gems that truly stand up to real-world trading. Have you ever wondered how top-tier traders who've been through countless market battles transform their trading intuition and market sense into precise quantitative code? The RAHA short strategy we are analyzing today is exactly that, a masterpiece where a seasoned short seller digitized years of hands-on experience. From every parameter setting to every condition check, you can see the author's deep understanding and unique insights into bear markets. This is not just a trading strategy, it is a textbook on converting subjective trading experience into objective quantitative logic. What is most impressive about this strategy is how the author perfectly integrated years of short selling experience into the code logic. The entire strategy reflects the complete thinking framework of a mature short seller. First is the keen ability to identify market noise, by dynamically adjusting the weight of each price point to filter out market static, making the moving average closer to the real trend. Second is comprehensive analysis across multiple time dimensions, completely mimicking how veteran traders simultaneously watch short-term momentum, medium-term trends, and long-term direction, forming a complete analysis system from fast to slow. Third is precise entry timing. The strategy designed two parallel entry logics. One is strict trend resonance confirmation, the other is classic bull trap identification. This dual-track design ensures both high win rate and will not miss key shorting opportunities. Fourth is a scientific position management system, ensuring each trade's risk is controllable and standardized. Finally, is a layered exit mechanism. This asymmetric design perfectly balances profit maximization and risk control needs. Behind every line of code, you can feel the wisdom crystallized from the author's countless real battles. This is not just a trading strategy, it is a complete short-selling trading system. As a veteran trader, the author uses trend indicators that are not complex, still moving averages, but the biggest problem with moving averages is they get thrown off too easily by market noise. It is like you are driving focused. Suddenly someone sets off firecrackers in your ear, and your steering wheel jerks, almost driving into a ditch. An experienced short seller can often judge intuitively which price movements are real trend signals, and which are just market noise interference. The author improved the moving average by setting up the RAHA function. Its core logic comes completely from the author's deep understanding of market volatility. The author converted this subjective judgment ability by controlling the sensitivity value to manage how the entire weight distribution system responds to outliers. This function simulates an experienced trader's thought process. First, observe overall market conditions, calculate average levels and volatility ranges, then evaluate each price point's credibility one by one, giving different weights. Finally, synthesize all information to reach a judgment. This approach is completely different from traditional simple averaging. It reflects how seasoned traders filter and weight complex market information. The design of 4 different period RAHA indicators further shows the author's mastery of multi-timeframe analysis. Short-term 5-period captures market sentiment, medium-term 10 and 20 periods grasp main trends, long-term 40-period confirms the big direction. This layered analysis framework is exactly the essential skill professional traders must have. The signal generation part is where the author's short-selling experience truly shines. First, let us look at the position state variable definitions. Entry high and entry price record the highest price and entry price when entering. These are the foundation data for calculating initial stop-loss and risk-reward ratio. The stop and TP variables dynamically track changes in stop-loss and target levels. The red count counter specifically monitors consecutive red candle occurrences. This design is completely based on experience judging bear trend continuation. The last entry bar variable prevents repeated entries on the same candle, showing strict control over trading execution details. Next comes the most essential short entry design. First, let us see a design that is sophisticated compared to amateurs, requiring confirmation from 3 moving average levels simultaneously. Long-term trend must be down, medium-term moving average system must cooperate, short-term momentum must also keep pace. This multiple verification mechanism might miss some quick opportunities, but can greatly reduce the probability of getting trapped or squeezed. Of course, relying only on the strict conditions of cycle resonance might miss many opportunities. Now, let me introduce the brilliant move of this strategy. The Bollinger condition design is simply a stroke of genius. It perfectly interprets a seasoned short seller's deep insight into market psychology. This condition captures a typical bull trap. Price breaks above the Bollinger upper band based on RAHA 20, creating a breakout illusion, attracting momentum money to chase highs, but ultimately closes as a red candle, exposing the weakness of bull forces. Only traders who've been through countless real battles can identify such subtle market signals, and the author converted this experience into specific code logic. The Quant-filtered condition design reflects strict position management principles by checking whether there is current position and last entry candle index, effectively preventing repeated entries and overtrading problems. This detail handling reflects the author's risk control experience accumulated in real trading. The strategy execution part completely digitizes the author's risk management experience accumulated in short selling. The 1% fixed capital risk setting behind this is a summary of countless bloody lessons. Any trader who survives in the high-risk short-selling field deeply understands the importance of position control. Position calculation uses scientific risk management methods. First, calculate stop-loss percentage, then work backwards from the fixed 1% capital risk to determine appropriate position size. But here we need special attention. When stop-loss distance is too small, the position calculated by fixed risk ratio might exceed the account's actual capacity. Therefore, in actual trading, we must add capital adequacy checks, taking the smaller of ideal position, and capital limited position, ensuring trade quantity does not exceed account capacity. This dual constraint mechanism ensures both scientific risk control and avoids trading failures caused by insufficient funds. The dynamic stop-loss adjustment mechanism further shows the author's deep understanding of short-selling psychology. When 3 consecutive red candles appear, adjusting stop-loss to the previous candle's high. This operation is completely based on experience judging bear trend continuation. This is not simple technical analysis, but deep insight into market participant behavior patterns. When bear trend is established, every bounce is a new shorting opportunity, and adjusting stop-loss position both protects existing profits and leaves room for further trend development. The exit logic design reflects the author's precise grasp of risk-reward balance. Profit-taking uses dual confirmation mechanism, requiring both price-hitting target level and technical signal cooperation confirmation exit 1 or exit 2. This design avoids premature exit during strong downtrends, while stop-loss exit is single condition triggered exit 3. Once price breaks dynamic stop level, it executes unconditionally, reflecting the absolute priority principle of risk control. This asymmetric exit design is exactly the survival rule that experienced short sellers summarized from long-term real battles. The visualization design reflects the author's attention to trading execution details. The visual presentation of red short marks and green close marks not only facilitates real-time monitoring, but also provides intuitive analysis tools for subsequent trading reviews. This simple yet effective marking system makes complex multiple condition judgments clear at a glance. The RAHA short strategy, with its dual-track entry mechanism and multi-timeframe confirmation system, shows significant advantages in specific market environments. The strategy's core competitiveness lies in simultaneously capturing both technical reversals and psychological reversal shorting opportunities, both entering at the beginning of clear trend reversals and identifying bull traps for precise sniping. Special attention is needed that during strong breakout markets, avoid counter-trend operations, as RAHA indicators may show lag. Strict execution of the dynamic stop mechanism is crucial, especially the stop adjustment after 3 consecutive red candles. This is the key link for protecting profits. Advanced application suggestions include combining volume shrinkage signals to enhance entry confirmation and using multi-timeframe analysis to improve operational precision. This RAHA short strategy represents a typical example of experience-driven strategies in quantitative trading. Its most outstanding feature is successfully converting subjective trading intuition into objective mathematical logic. The author, as a seasoned short seller, not only possesses keen market sense, but more remarkably has the ability to objectify subjective experience. Every design detail in the strategy, from RAHA algorithm weight allocation to short condition settings, shows deep practical skills and precise grasp of market psychology. Although the strategy may have adaptability issues in some extreme market environments, this attempt to successfully digitize personal trading style provides valuable reference for traders. It tells us that the best quantitative strategies often do not come from complex mathematical models, but from deep market understanding and refined essence of years of real battle experience. If you hope to convert your trading experience into quantitative strategy code, welcome to the Inventor platform for in-depth research and practical exploration.